Hey everyone. Hey, it's Phil Hodgin once again. And this is once again the International Tax Lunch. Last Friday of the month, noon Pacific time, on the YouTube recorded, but live right now, courtesy of CalCPA. And thanks, CalCPA, for this. And thanks, Robert, for helping me with the production again this month. This month, by the way, you got it live here. We post it later on YouTube, so you can find us. Just look for Hodgin Law and in YouTube, and you'll find all the old recordings. This month's topic is foreign grantor trusts. So this is this little series that I've done so far, and we're on episode 3 now. Last month we did foreign grantor trusts, and this month I'm going to do foreign non-grantor trusts. And this is an overview because foreign non-grantor trusts are more complicated than foreign grantor trusts, so we can't cover everything in an hour. And also because I'm going to get nerd-like next month when I'm going to have a whole hour just on accumulation distributions to a U.S. beneficiary from a foreign non-grantor trust. So we're going to get deep into the math, and this will have numbers in boxes and all that sort of stuff, so you can see how it really works. And also related to foreign non-grantor trusts, and in fact, foreign grantor trusts, we're setting up the season next year for Cal CPA, and there will be a whole episode just on Form 3520 and a whole episode just on Form 3520 Cap A for foreign grantor trusts. So we'll get into the weeds there. So today is really, I'm sort of hitting the highlights of foreign non-grantor trusts, and you can see from the table of contents that I'm looking at it from two perspectives. I'm looking at it from foreign non-grantor trusts. They'll have income wherever, but the key problem for U.S. income tax purposes is that they have U.S. beneficiaries. And so when money comes out of the foreign grantor trust to the U.S. beneficiary got a problem. And then I'm going to go into foreign non-grantor trusts that have U.S. assets and by definition are going to have U.S. income. And there we have two problems, one of which is how does the trust get taxed on its U.S. source income? And number two, by far more important than the income, because income tax is what it's going to be, it's no great shakes, is the estate tax. And if the foreign non-grantor trust is set up wrong, the person who formed it, the settlor, if you want to call it that, which is the word that people use, will have a retained interest, and therefore the U.S. assets will be subject to estate tax if the settlor, in a moment of bad judgment, decides to become a decedent. So they're going to do that, and then I'm going to give you an example, foreign non-grantor trust that happens to own U.S. real estate that's a personal use asset, which is fairly common in our practice, and it has one of the many beneficiaries is a U.S. beneficiary, and how do things happen in that context, just so you can see how these two concepts roll together. So let's get on it. Introduction. So as I said, this is necessarily an overview, and I'm not going to pick out all the nerdy stuff. I'm not going to pick out all the stuff that someone who is drafting a trust or reviewing a trust document will necessarily look for, using the lawyer eyeballs. We're looking at it from a tax professional's eyeballs. And the biggest problem with foreign grantor, non-grantor trusts that have U.S. beneficiaries is the accumulation distribution problem. Well, distributions generally, but if the trust accounting is done correctly, there's going to be some accumulated income because typically trusts will not distribute all of their income out on an annual basis. And so we've got this problem going on of how does the beneficiary pay the tax? And then, as I said, for the U.S. assets, it's the settlor's estate tax exposure by way of retained interests. So let's start now with the foreign non-grantor trusts with U.S. beneficiaries. Start from the beginning, and when I look at complicated stuff in tax, I try to look for what's the problem that Congress was trying to solve when it created this absurd complexity of a tax system that is accumulation, distribution, taxation. And usually at the bottom of it is a very simple thing that taxpayers were doing, and Congress decided they didn't like it. So let's start at the beginning. Foreign non-grantor trust, for income tax purposes, is taxed just like a non-resident alien individual who never enters the United States. So, boom, human being. And the idea for an individual non-resident alien is that the gross income that's exposed to U.S. estate income tax is U.S. source income. And this is just the traditional idea of U.S. source income. And you can see section 872 little a. This is the definition of gross income for U.S. income tax purposes for this person. And I don't put it here, but the tax rules that apply are section 871, which says that fixed, determinable, annual, or periodic income, passive income, is taxed at 30% of gross. And effectively connected income, if there's a U.S. trade or business, is taxed net income. You're allowed to take deductions just like a resident taxpayer. So that's the way it works. So if you've ever done a 1040 NR for a non-resident alien individual, you know exactly how the taxable income is computed for a foreign grantor, non-grantor trust. Now, implications of this. Assume that you've got a foreign non-grantor trust and it carefully invests in foreign assets, therefore generates foreign source income. So think of it first like a human being. You've got someone who is a resident of Dubai, investing in various assets outside the United States, earning income. There's no tax, right? So the same thing for foreign non-grantor trust. As long as they earn income outside the United States, there's no U.S. income tax. And simple math, compounding rates of return say it's better to not have tax than is, so you're going to make more money. By contrast, look at the same idea. If you have a domestic non-grantor trust, it's an absolute clone of the foreign non-grantor trust we're talking about, and it's earning the same foreign source income. The only difference is domestic non-grantor trust, it's going to pay income tax on its foreign source income at whatever the rates are. And there you have it. And so after a year of income of $10,000, the foreign source income in the foreign non-grantor trust, still $10,000 there. The $10,000 in the domestic non-grantor trust is going to be $10,000 minus whatever the tax is, $2,000. So let's say $8,000 left over after tax. And this is something we all know, that it's better to have money that's not getting taxed on its return than it is to have money in an account that's getting taxed. It's the difference between an IRA and a regular taxable account at Schwab, for instance. So here's my little math that just shows you the effect of starting with $100,000, waiting 20 years, investing it, assuming a 10% rate of return over the years, assuming the domestic trust pays 25% tax rate and the foreign trust doesn't. At the end of the 20 years, there's 672,000 and change in the foreign trust and 424,000 and change in the domestic trust. And so you have the Internal Revenue Code at its first cut biased towards it's better to put all your money in a foreign non-grantor trust and then distribute it out 20 years later to the U.S. beneficiary because there's a lot more money in the trust. Congress don't like that. So then this is why we have the throwback rules. And throwback rules are, I don't know why, well, it's jargony. It confused me for the longest time. But you find these in sections 665 through 668. And the idea here is that if income is accumulated in a foreign trust, Uncle Sam can't tax that income until it's distributed. But Uncle Sam can certainly tax that income when it is distributed to a U.S. beneficiary. And so the distribution is included in the beneficiary's gross income. And we have these throwback tax rules that apply to that distribution to calculate exactly how much of that accumulated income that was distributed is going to be taxed at, what rate, and what it all adds up to. And the throwback rules, they more or less equalize the present value, future value. Say, in a perfect world with perfect math, we're indifferent about whether you put it into a foreign trust or a domestic trust, because the net result after distribution at any given point in time from the foreign trust to the U.S. beneficiary is going to be roughly the same. So and you'll see when we come to it that there's an interest component that's designed to make that present value, future value thing kind of equalize more or less as best you can. But let's first talk about what's a distribution. What's a distribution from a foreign non-grantor trust? Because distribution means more than just an actual, here you go, here's $10,000 of cash. For foreign non-grantor trusts, distributions in the normal style that you'd expect, a distribution of cash, a distribution of property, is a distribution. And we've got to figure out the U.S. beneficiary's income tax that's imposed when receiving that distribution. But there are two other things that a trust can do that are treated as distributions, even if they are not intended to be distributions. One of which is loans. And of course, they say, I'm so clever, I'm not going to take a distribution of $1 million. I'm going to borrow $1 million from the trust, and therefore I don't have $1 million of income. Well, hold on a section. Section 643I says, no, a loan from a foreign non-grantor trust is going to be treated as if it's a distribution to the U.S. beneficiary. And we'll talk about that in a little bit more detail in a couple minutes. Similarly, if a trust owns property and lets the U.S. beneficiary use that property without paying for it. The trust owns a house, the U.S. beneficiary gets to go live in the house rent-free. Uncompensated use of trust-owned assets is going to be treated as a distribution equal to the fair market value of what that use is. So in the case of a home, what would it rent for? That's how much you're going to have as a distribution. So loans are treated as a distribution to a U.S. beneficiary, and that's okay. I mean, that's pretty straightforward because that closes an obvious door. But there are a number of rules that relate to indirect loans to a U.S. beneficiary, where a loan to somebody else who is related, and related meaning the Section 267 rules and the Section 707B for partnerships. If it's related to the U.S. beneficiary, then the beneficiary is treated as if receiving a distribution. So look at what's happening here, that if you have the trust loan money to the wrong person, the U.S. beneficiary has to pick up a trust distribution with potential income tax consequences, even if the U.S. beneficiary never got the money. And I'm going to talk a little bit more about related party stuff, but for any time you see a loan out of a foreign non-grantor trust, really scrutinize it carefully. Who is the borrower? Is the borrower related in some way to the U.S. beneficiary? Because if there is, there's a big problem with it. And the proposed regs that came out in May 2024 go into some depth on this. There is an exception, it's called a qualified obligation, and you can see there's a whole section in Form 3520 where you have to list all of the qualified obligations, which is a loan from the trust to the U.S. beneficiary or to a related party, even a non-resident alien related party, by the way. And these loans will be treated as loans and not as distributions if they meet the requirements. So less than 5 years maturity, you got to have it in writing. It has to have AFR minimum level of interest stated. and then you're okay. And I give you the citation to the proposed regs for what a qualified obligation is. So bottom line, have your eagle eye out looking for loans from foreign non-grantor trusts, because these may be indirectly treated as a distribution to your U.S. beneficiary for whom you're preparing a tax return. Same thing with uncompensated use of trust-owned property. So again, the typical example, a house, a vacation condo in Vail, something like that. The U.S. beneficiary goes and uses it. The fair market value of the use is deemed to be a distribution to the U.S. beneficiary. Similarly, used by a person related to the U.S. beneficiary. Could be a non-resident alien again. There's no qualified obligation counterpart for uncompensated use of trust-owned property. The only thing you can do is have arm's length payment. So if the condo would rent for $3,000 a week in Vail, the U.S. beneficiary has a choice of either paying $3,000 to the trust, and the trust has income, or the beneficiary has a $3,000 distribution using the place for a week. So there's the thing to watch out for. And at the end, in the example, I will give you an example of a foreign non-grantor trust with a U.S. beneficiary and a residence, and you'll see the income tax implications of having these deemed distributions out of foreign non-grantor trust. Now let's look and say, okay, what we've established so far is a foreign trust with foreign source income can never get taxed by the Internal Revenue Service because it's like a non-resident alien income, individual earning income overseas. But IRS still wants money, right? Okay. So the only other place to tax it is on the U.S. beneficiary as money comes out of the trust, which is the normal way that trusts work as a flow-through entity anyway. So we have, to stipulate, we have a distribution. And as the distributions will either be of income earned in the current year by the trust, or it will be out of the bucket of either income earned in prior years or principal, contributed assets at the inception of the trust. And in that way, I mean, think of it as a rough analog to corporations and earnings and profits, right? You got a distribution. What's the distribution to a shareholder going to look like? It's going to be from current E&P. It's going to be from accumulated E&P, or it's going to be a return of capital and the tax consequences thereof, flow. So it rhymes in the trust world. And what we have in the trust world is for the current amount of income distributable and therefore taxable to the beneficiary in the current year, we call this distributable net income. You start with taxable income, you do some adjustments, and you end up with a number called distributable net income, D&I. And I'm not going to get into details on this because I'm going to get into details next month when we do some math. So we'll get into details of what does the D&I, distributable net income, look like. So, but the picture that you need to understand for now is that when a distribution is made, it is taxable as current income, and it carries through the same character of income, qualified dividend, long-term capital gain, blah, 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 as it did in the hands of the trust. So that's up to D&I. Any distribution amount above distributable net income is going to come out of either accumulated income from prior years or from capital, corpus, principal. And there are two methods that we use to calculate how much of a distribution is from current income, from D&I, how much is coming from accumulated income. One's called the actual calculation method or actual method, and this just follows along. If you've got well-behaved trust accounting for the trust, you know its history, and you can allocate for different years, year on and year out, How much money did the trust earn that year? How much did it distribute? How much did it not distribute? And that amount that was not distributed is called undistributed net income, UNI. And so the trust accounting gives you the numbers. The other method for calculating how much is ordinary income for the current year and how much is from accumulated income, it's called the default calculation method or default method. And here we say, well, we don't have any trust records. They were lost in the boat accident. And therefore, we've got to find some way of calculating if my beneficiary received $100,000, where'd it come from? How is it characterized and how is it taxed? And this is the default method. And it's just a simple formula that you look at the current year distribution amount, you look at what happened in the prior 3 years, you do some simple math, and it will allocate the current year distribution either into ordinary income from the current year or to accumulation income that's distributed in the current year. And I'll go through both of them later too. Now, implications of this. The distribution out of DNI will be that it's taxed same character as always, ordinary income straight pass through, like a K1. The implications for the accumulated distribution, the distribution of accumulated income, I should say, to be precise, it's coming out of undistributed net income for prior years until you use all of that up, and then it's coming out of principal, which is normal. And if you stop right there and you think about what would be the logical way to do it, you would say, well, you look at all of the trust accounting for the entire year time that the trust has been in existence. You look year by year, and you've got these little buckets of UNI, undistributed net income, that's accumulated year in and year out. And so in the year that there is a distribution of accumulated income, you use first in, first out principles. You go way back to the beginning and you tag that and use up all the UNI for that year until and then you go on to the next one and the next one. And when you've used up all the UNI, then you say, well, the rest coming out must be contributed capital, and that comes back to the beneficiary tax-free. And that's the theoretical concept, but just the way I described it, you can see that for any trust that's existed for any period of time, the likelihood that you're going to be able to have a great archive of trust accounting records to do this math is going to be damn near impossible. And that's my experience anyway. So the theory of doing it that way, and again, is like E&P. Go back and use up the accumulated E&P bucket by bucket. The math is just not going to be there for you, or I should say the evidence is not going to be there so you can do the math easily. So what we do is, in that case, we go to the second method. We're going to, let me just complete the loop on the actual method. Instead of having this year by year back to the year one, they have an averaging method, and I'll show you some simple math on Form 4970 in a second about that, where you only have to look at the previous 5 years of tax returns filed by the beneficiary to figure out how much the tax is going to be. The default method just uses the little handy dandy formula, and it calculates the accumulation distribution amount for you. And then you can go on to Form 4970 and calculate the tax. Now, essential to this whole thing is whether you get or do not get a foreign non-grantor trust beneficiary statement. So this is a sort of freestyle analog to a Schedule K1 that a domestic non-grantor trust would give. In other words, it gives all of the data necessary for the U.S. beneficiary to calculate how much income the beneficiary, what the distribution was from the beneficiary, from the trust, and then how much of that is income, how much of it is, if it's a current year distribution, is it long-term capital gain, qualified dividends, tax-exempt income, corpus, and how much is accumulated distribution. If you don't get that, and there it is, notice 97-34, The instructions for Form 3520 don't give you a lot of detail, but the notice gives you some detail about what to put in there. Whether you get this or not is sometimes a question, and not getting it has some implications, as you'll see in a few minutes. You have a choice, so you being the beneficiary. What are you going to use? And here you are in Form 3520, where the rubber meets the road on that choice. If you get a foreign non-grantor trust beneficiary statement from the trustee in the year that you receive the distribution, you have a choice to either use the actual method or the default method. And so that second sentence at number 30, if yes, attach the statement, so you have to bolt the statement onto the beneficiary's income tax return, to the 3520, and complete either Schedule A, which is the default method of calculation, or Schedule B, which is the actual method of calculation below. So you get a foreign non-grantor trust beneficiary statement. Your life is in your own hands. Yay, we like that. And then it says, complete the Schedule C. I'll show you what Schedule C looks like in a second. This is calculating part of the tax. But look at the second one. If you do not get a foreign non-grantor trust beneficiary statement, the only option you have is the default method. And so you're stuck with that. You're not allowed to use the actual method. In practice, the actual method is almost certainly going to be better for you. And the reason is because for the default method, 100% of the distribution is treated as taxable, even distribution of capital. So everything is taxable. The only question is whether it's going to be taxable as ordinary income at whatever marginal rate, the highest marginal rate is for the beneficiary, or it's going to be taxable as an accumulation distribution. So in general, default method bad, actual method good. And you want to use the actual method if you can. The other thing about actual method and default method, you know how in PFIC there's this rule, once a PFIC, always a PFIC? Well, once you use the default method once for a U.S. beneficiary, you're stuck with the default method forever until the year of trust termination, in which case you can go back to the actual method. So it's a one-way road once you get into the default method, and you try to avoid it if you can. So let's just walk through it real quick here. And again, next month, same thing with numbers. This month is just concepts. Schedule B is where the actual method works. And you can see here 41. Line 41A, you insert the number that the trustee gives you on the foreign non-grantor trust beneficiary statement. They'll say, here's your number, buddy. And you put it right there. The other stuff above and below is not relevant, or you can see it's obviously not relevant to what we're talking about here, and doesn't, relevant to other stuff. But it's about the current year distribution, 40A, here's the ordinary income for the current year. You can see short-term capital gains on 42A. So again, they're tracking the character of the distribution for them, for things that are not the accumulation distribution. So all you get out of 41, Schedule B here, is a number on line 41A, which you're then going to move over and say, okay, I know I have $10,000 of accumulated income. What am I going to do with it? And Form 4970 is where you go for it. And this is Form 4970 calculates the tax on the accumulation distribution based on a kind of weighted average game. And they just look at the prior 5 years of tax returns filed by the beneficiary, throw out the high year and the low year by taxable income, and use the 3 middle years. And what you do is you calculate the U.S. beneficiary's income tax liability as it was on the income tax return. So that's easy peasy to do. You just copy. And then what you do is you allocate the accumulation distribution across those 3 years. So I've got that accumulation distribution flagged there. At a high level of what you're saying is, let's say the accumulation distribution was 30,000 that year. You're going to plop 10,000 on each of those boxes and away you go. And now you've got a higher level of taxable income for that year because you've thrown back some of the income received in the current year to previous years. And you calculate the tax liability with the add-on of the extra income from the accumulation distribution. And the difference between what you paid on the original return and the amount that you calculate here on Form 4970, that tax incremental difference is the first half of the throwback tax. So that's how this works. And you see down at the bottom, I call it the first part of the income tax on the accumulation distribution. So the actual income tax, and it's taxed at ordinary rates, so no long-term capital gain for you, boo-hoo. And note that it's adding on to the top of the taxable income that the taxpayer had originally. So it's going to be taxed at the beneficiary's highest marginal tax rate that applied for that year. There's a second charge, tax. It's an interest charge, but it's characterized in the code as a tax. So it's a tax. And this is, you now look at the distribution and you say, okay, I owe an extra $1,000 of tax, but I deferred the moment of time at which I should have paid that $1,000 of tax by 5 years. So I should pay 5 years of interest at the underpayment rate on that tax, and this is what this number is. And again, we go back to what's the theoretical thing. You know, in theory, you should go back to each year, year by year, and you've got a bucket of undistributed net income, and you should calculate the interest for that, and the interest for the next one, and the interest for the next one. But in fact, there's a weighted average methodology for this too, which makes your life a little bit easier, because who's going to have tax returns from 1981 lying around? If the trust happened to be in existence in 1981 and accumulated some income, nobody's going to have this. And just think of the brain damage that you as the preparer would have to go through to go back and do all of these calculations. So that's why the weighted average sort of calculation applies. So that's that. Assuming you've got a foreign non-grantor trust beneficiary statement and you used it religiously every year, that you received a distribution, you're in that, and that's the method you'll use to calculate the tax on the accumulated distribution. Now the default method. It's really pretty simple. And I've got words in the 2 or 3 slides from now that explain it all, just so the slide deck will be complete and you can figure it out later. But you start with the amount of the distribution received on line 31. Then you go back and you look at how much did I receive in the last 3 years in distributions. You add that up, you multiply it by 1.25, so 125% of what you actually got, and then you divide by 3, and you have sort of an annual threshold, a cutoff number based on that. So 125% of the average actual distribution and is your cutoff. Any distribution received below that cutoff is going to be ordinary income. Any distribution received above that cutoff is going to be an accumulation distribution. And then after you calculate the amount of accumulation distribution in Schedule A, you go over to Form 4970 and calculate what your tax is over there. And then you go down to the bottom of Form 3520 Part 3, Schedule C, and you calculate that interest charge that's called a tax there. And both of those tax numbers go over to your Form 1040. So here's my little slide that just describes, just has the numbers and the description of how it all works and how you do the multiplying and dividing to figure out this threshold above, below, whether it's ordinary income or accumulation distribution. Now, I want to give you just little sample examples of, let's say that trusts have been in existence for who cares how long, and you're locked into the default method for whatever reason, and the trustee wants to distribute $60,000 to a U.S. beneficiary. Well, if the distribution happens in 2024 and you're preparing the 2024 tax return, you've got a $60,000 distribution. The sum of the 3 years prior distributions, there were none, so it's zero. 125% of zero is zero. And the divide by 3 in line 35, 1/3 of zero is zero. So how much of that is going to be ordinary income? Below the threshold of zero is zero, and above the threshold of zero is 60,000. So the entire 60 grand is going to be an accumulation distribution. And what that means is that 60,000 of accumulation distribution income that's going to be taxed at the maximum marginal tax rate as ordinary income. And then it'll have that interest charge on top as a function of how old the trust is. Well, let's look at a couple different ideas. Let's say, all right, I'm a patient man, I'm the trustee, and I'm not going to give you a lump sum, but I'm going to give you $10,000 a year, and it'll add up to 60,000 in the long run. Let's see how it works. So 10,000 a year starting in 2019 and ending in 2024. And you can see here my math is. So in the first year, we have the same result. How much was distributed in 3 prior years? Zero. So the first year distribution is all accumulation distribution. The second year, 2020, how much was distributed in the prior 3 years? Well, 10,000, right? Well, 10,000 was distributed last year in 2019. 125% is 12.5 divided by 3, 41.67. So the first $4,167 of that 10,000 distribution is ordinary income, ordinary rates, and $5,833 will be accumulation distribution. 2021, you can see the cumulative effect. Now we've got 20,000 distributed in the prior 3 years, and 125% of that is 25,000 divided is the average distribution per year is 8,333. So the first $8,333 of the 10,000 distribution will be ordinary income, and the rest is accumulation distribution. And from then on out, the threshold is going to be an annual 12,500, and the distribution will always be underneath that threshold. So the entire distribution will be ordinary income. And from this, you can take a sort of general, eyeball view that when you're using the default method, you got to figure that there's going to be accumulation distribution that's painful, and therefore the tax liability is going to be painful in the first 3 years. But after that, it's just going to drop to ordinary income. So when you have a trust that you are trying to drain dry and then throw away the trust, in general, the idea of incremental distributions out over the years is going to be a better one than just a giant lump sum all at once. And 12% annual increase in the amount of distribution turns out to be the magic number. So here I have an example of starting low, $7,394 for the first year distribution, increasing that distribution every year by 12%, ending up with $60,000 distribution, rounding 60,004 here. And you can see that in the first example, we had 17,500 of accumulation distribution that was taxed at a higher rate, whereas in this methodology, we have $15,338, which was taxed as an accumulation distribution. So not fun, but not as bad as the giant lump sum all at once. So 12% is your number. Start low, start incrementally rolling up. And even if you have a big trust with a lot of money in there, it might take you a bunch of years, but the 12% compounding every year is going to get you up to some pretty large numbers for trust distributions over the course of several years. Now, just to show you that you don't want to go above 12%, I've got a simple math example where the annual increase in the amount of distribution is going to be 15%, again, aimed at a target of 60,000 to be distributed. So we start even lower, but we're increasing by 15%. And you can see how the first 3 years of accumulation distribution are there as to be expected. But then 22, 23, and 24 all still have accumulation distributions because the amount of the distribution is going to be higher than the average amount, the line 35, that's there every year. So we have slightly higher accumulation distribution. So you have a penalty for going above that 12% increase in the distribution amount every year. Summary of all these numbers, the accumulation distribution, and remember the accumulation distribution is the taxable income, on which the tax rate is going to be higher. This is not the tax liability itself. So the moral of this story, and I do have these fairly frequently, where we got this trust and they've transferred trustees 2 or 3 times, and the trust been in existence for 40 or 50 years, and we've lost decades of trust records and bank statements and whatnot. So we have no way to reconstruct any kind of plausible trust accounting. We're stuck with the default method. My first suggestion to people always is start low, whatever number you want, increase by 12% annually, and you'll eventually get there and drain the trust dry. So the conclusion here. The big problem with accumulation distributions is that it's going to be taxed as ordinary income. You lose capital gain preferential long-term rates. You lose qualified dividend long-term rates. So you're maxing out the income rate that applies to this distribution. That's not by accident. And then you add the interest charge calibrated to the life of the trust over which the income has been accumulated, and you nuke out that present value, future value possibility of deferral of income, and you end up with a situation where it's really not economically effective to set up a foreign non-grantor trust that has U.S. beneficiaries unless you take great pains to distribute all of the income annually to the U.S. beneficiary. So you use up all the DNI, so there's no undistributed net income. But in that case, this sort of defeats the whole purpose of a trust, which is to accumulate and build wealth over decades and generations. Here, you're draining it every year back to capital. So that's not so good. So in general, domestic trust is going to operate better for U.S. beneficiaries. Now let's move on to the other part, which is the foreign non-grantor trust with U.S. assets and income. So the primary problem here is not income tax, but estate tax. And estate tax comes from what's called a retained interest. This is sections 2036 through 2038 of the code, where a decedent, a human being who has died, owned at the time of death a retained interest in the trust estates. In English, think of it like this. The person created the trust, made a gift of an asset to a trust, but had strings attached to that gift. It could be economic strings. I have the right to receive distributions of income or a right to receive some principal back. It could be control. I can control who gets the money. I can control what the trustee does, stuff like that. So either an economic or control interest is retained. Again, just a brief overview: income taxation of foreign non-grantor trusts with U.S. trust income. Non-resident alien never sets foot in the United States. You've got FDAP, you've got ECI, Section 871. That's how it's going to be taxed. But now let's look at the estate tax and spend a little bit of time here and look at why this is a problem. Well, the first problem is that a non-resident non-citizen, and I'm using that because there's a difference in definition of who's a non-resident for estate tax purposes and gift than there is for income tax purposes. So just because someone is a non-resident alien for income tax purposes does not mean that they are a non-resident, not a citizen of the United States for estate and gift. Non-resident, not a citizen means where's their domicile? And typically domicile is going to be outside of the US. So just watch for that. But the point is, when a non-resident, non-citizen, non-domiciled individual owns US assets and falls over dead, the unified credit amount is only $13,000, which protects 60,060 of US situs assets owned at death from the estate tax. So everything above that number is going to be subject to U.S. estate tax. So as compared to U.S. residents and U.S. citizens, where in round numbers, the way it's floating and who knows what will happen in Congress, around numbers 14 million each will be tax-free at the time of death. And typically what I see in my practice will be people who make investments here in U.S. real estate. And if they're a house, they have furniture in the house. And so that's personal property, the furniture. And they've got a car in the garage to use while they're here. So that's personal property that's located in the United States. They have art on the walls. All of this is U.S. situs asset. That's what we see. You can also see people who are non-residents and they become partners in a U.S. partnership. The U.S. partnership is a U.S. situs asset. They buy stock publicly traded, Google, Apple, whatever. The company is formed in the United States under U.S. law. It's a U.S. situs asset. They fall over dead owning that stock. There's estate tax. So this is what you're going to see. And in general, they're going to be investment assets. And this is what the estate tax risk is all about. And what do you do about that? Well, you either put it into a foreign corporation structure to eliminate the estate tax risk, because then the decedent is a shareholder of a foreign corporation. Foreign corporation owns U.S. assets and the stock of a foreign corporation. All right, we're back with some microphone problems. So after this, we have estate tax risk. You put it in a foreign corporation, and that protects U.S. situs assets from U.S. estate tax of a foreign person. Or you put it into a foreign non-grantor trust, which also can protect from U.S. estate tax problems, because who owns the asset when the decedent dies? The trust. And trusts don't die, therefore there's no estate tax problem for that. But the only way that it can happen is, as I said earlier, if the person who made the gift to the trust made a gift with some strings attached, aka retained interests. Similarly, if you're a beneficiary and you have what's called a general power of appointment, that is treated as sufficient power over the trust assets to functionally treat that asset as belonging to you. And therefore, if you fall over dead, that the trust assets will be subject to U.S. estate tax. So retained interest, an interest. I have the right to receive income for life from this trust. That's an economic interest, but what makes it retained? And the answer is that it's hardwired. When you signed the trust deed, that right was hardwired into the trust document. That's the simple answer. The same interest, the same right to receive income from the trust can be bestowed upon you by others in the future, and that's not a retained interest. It's the fact that you, at the inception, held back some of the rights to that property. In my example, the income interest. And here's just a list of the 4 retained interests in Section 2036 through 2038. And there's no great magic about it. You retain the right to receive distributions of income or to use trust property. You retain the right to have a reversion of the capital of this trust greater than an actuarial computed interest of 5%. You retain powers, the power to define who gets to receive the assets. So if you still hold back the power, well, I get to choose between my kids who gets what, then that's a retained interest. And finally, the most common one, the power to revoke or amend the trust. So a revocable trust is a retained interest, and you are taxed on those. General power of appointment in simple language is this is something hardwired into the trust document that says, it names the person and says, this person has the right to instruct the trustee to do anything with the trust assets, including put the money into that person's own pocket. So the power holder can instruct the trustee to give him or her money. And that's a general power of appointment. There's another kind of power of appointment called a limited power of appointment, where you can spray the money all over the world to anybody except to economically benefit yourself or pay off your debts or give it to your estate so you can choose who inherits the money. So you will be looking, and a well-drafted trust document will carefully avoid these things, because the whole point of a trust is to avoid inclusion of trust assets in the gross estate of the decedent. Specifically used. Here's a situation where I think it is specifically interesting to use this. A lot of people will buy into U.S. partnerships, hedge funds, real estate investment partnerships, things like that. And the non-resident alien is going to have U.S. source income from the partnership. You're going to get a K-1, and that'll be included, and you'll report it on a 1040 NR. But this individual is also going to have a U.S. situs asset, because the partnership interest is a U.S. partnership, and so the asset, and therefore the asset value, will be subject to U.S. estate tax if this partnership interest is still owned by the individual when he or she dies. And you can put this partnership interest and have the partner be a foreign corporation instead of an individual, but there you have a risk that the partnership income will pass through to foreign corporation and be taxed at 21% income tax rates, corporate income tax rates, and also the branch profits tax rate of an additional 30% over there on top. And in addition, this is going to create a world of complexity for the partnership in terms of withholding and reporting, and they just generally may not like it. And so people will put a foreign corporation with a U.S. subsidiary, and then the U.S. subsidiary owns the partnership interest. Well, now you have a C corporation that's going to receive income and file and pay income tax at corporate rates. And how are you going to get that money upstream to the foreign parent without a 30% tax withheld at source on the dividend? So it gets messy with a corporate structure. The alternative is to have the partnership interest held by foreign non-grantor trust, where you get the same income tax treatment, straight pass through to the non-resident alien individual, or the taxes paid at the partnership at the trust level, but you have eliminated the estate tax risk. So I think that's useful. The other place that I use it a lot is with U.S. real estate investments, because it's useful, especially for personal use assets. And with that in mind, and handy dandy transition, let's look at one such situation. So we have a foreign non-grantor trust that has a U.S. asset, namely a personal use residence for use of the family in the United States. So bail condo, house in LA, condo in New York, whatever it is. And let's just further assume that it's one of these situations where there are 4 kids, one of whom is a U.S. citizen. The others are non-resident aliens. Mom and dad are not U.S. citizens. So what do you do on that? Now we come back to the original idea, and let's assume away the estate tax problem. It's fixed. We did it right. We're just looking at the U.S. beneficiary and the U.S. beneficiary's income tax problem. So we start from the top that says, when you have uncompensated use, I said it right, of trust-owned property by a U.S. beneficiary, that's treated as a distribution from the trust. Okay, you have problems with a distribution to the U.S. beneficiary if a related party uses the house for free. And the trust will treat this as an actual distribution to the U.S. beneficiary. And then what's going to happen is the U.S. beneficiary either uses the actual method or the default method to calculate the tax cost of using this place for free. So let's first look at just the simple example. The condo in Vail, and the U.S. beneficiary goes and stays there for 2 weeks and uses the condo in Vail and has fun. Well, what's the fair market value rental of that place if you put it on an Airbnb? That's going to be the deemed distribution amount to this U.S. beneficiary. So red dotted line, it's a Section 643I distribution to the U.S. beneficiary. Now let's look at another situation where you have a non-resident alien beneficiary. The U.S. beneficiary does not go even close to Vail, never uses the place ever, never goes to the condo, never goes skiing. But a non-resident alien who is not a beneficiary of this trust, but is related to the U.S. beneficiary. So, hey, mom and dad go and they use the condo. Now what happens? They use it for 2 weeks. Answer is that this is a distribution of 2 weeks worth of rental income to the U.S. beneficiary. So this is an indirect use of the condo in Vail by someone who is related, and the related party rules is Section 267 defines who is related. So all of a sudden, just because mom and dad decided to go to Vail for 2 weeks and go skiing, U.S. beneficiary has a trust distribution and potential U.S. tax liability. And I want to just look at this by comparison to a domestic trust. If they set up a domestic non-grantor trust to hold this condo in Vail, what would happen? The U.S. beneficiary or anybody could use it, and there would be no deemed distribution to the U.S. beneficiary because Section 643 only applies to foreign trusts. Now, what's the tax consequence of this? Well, if there's the actual method of distribution to the beneficiary, I'm going to go back a slide to this. The actual method says a distribution is taxable to the extent of distributable net income, D&I. If the trust never has any income, then there's no D&I, and therefore it could never have any current income, D&I, or undistributed net income, UNI. Therefore, this is just treated as a principal distribution if you use the actual method. But if you use the default method, you're in a world of trouble because every distribution, doesn't matter what it is, even distribution of capital will be taxable either as ordinary income or as an accumulation distribution. So if you are locked into the default method for this U.S. beneficiary, somebody else could go use the condo in Vail and create a tax liability for the U.S. beneficiary who is sadly unawares of it. So this is where the problem lies. Number one, the fact that related parties use the place and create taxable liability for the U.S. beneficiary. Number two, if the trust accounting is not squeaky clean, there's going to be some income tax to pay because we're using the default method on Form 3520. Well, let's wrap it up. So foreign non-grantor trusts, I'm dim on them for when you have U.S. beneficiaries. They create a lot of problems. I haven't even mentioned the profound penalty problem of missing a Form 3520, which is just a mess. 35% of the amount of distribution is the penalty. The throwback rules themselves create an economic incentive to not use this. It creates a high tax rate for the U.S. beneficiary. I personally think they are an excellent way to hold large quantities of U.S. assets for a foreign family group. Like you could put a lot of personal use as well as investment properties on using a foreign non-grantor trust as sort of the holding company for the U.S. assets, if you like, and get good performance out of it. The big downside for foreign non-grantor trusts, quite frankly, is it's pricey to set these things up and run them every year with trustees' fees and accounting and whatnot. So do people use them a lot? Only at the upper levels in terms of asset values and income. Next month, just to flag it, I'm going to be walking through the Form 3520, showing you the default method and the actual method for calculation of a distribution. So come back next month for that. And this is the end. Thank you for staying around, even through the audio mess this month. Sign up for the newsletter and maybe join the community at pro.internationaltaxlaw.com. Thanks a lot. Bye.